Good evening, friends. Thank you for joining us for one more interesting session. Uh, the Indian markets have rebounded very sharply post-March, and it is very difficult to imagine that in the same year we had the month of March and April when everybody was talking about a Nifty coming further down. We had already seen levels of 8,000, and today as we speak, we are at a Nifty of 13,500. The month of March and April saw extreme high foreign redemptions, and in the month of October, we saw extreme high foreign inflows of close to 55,000 crores. Um, People have now started talking about valuations. People have started talking about a threat of a second wave of COVID. Everybody was expecting a second wave of COVID post-Diwali. That seems to have been delayed. Uh, Considering that the fiscal 2021 is more or less write-off, most people are still talking about 2022 and massive recovery. To get more insights on investment ideas on the way to recovery, we have the pleasure of the company of Mr. Naren. Naren is the Executive Director and Chief Investment Officer at ICICI Prudential AMC. And he's a leading voice of Indian capital markets, having observed capital markets from close quarters to over 3 decades. He's known to be a contrarian value investor. He was, just example, he was one of the earlier investors in Bharti Telecom when everybody was writing off Bharti. His mantra is to identify a theme, a neglected sector, or a stock before anybody does, and holds it till it comes to limelight. For me, he symbolizes both the importance of top-down approach as well as bottom-up stock picking. And the most important thing is that he has a strong courage of conviction, even ability to take hard decisions, although the market might not support him in the short term. He's an extremely well-read person, and he follows the teachings of James Montier, Harvard Marx, Michael Maupassant. He's an alumnus of IIT Madras. I am Kolkata, and before taking over the responsibility of CIO of ICICI Pru AMC, he has stints in HDFC Securities as well as Refco SIFI. So before I ask my first question, I welcome Naren to this talk and ask him to give his opening remarks on how he handled the entire volatility of 2020 and also his outlook for the coming year 2021. Over to you, Naren.
So I think Venkat is going to ask me a lot of questions on 2020. So I'm going to talk a little bit about, I spent 10 years as a retail stockbroker. And so, I have dealt with a lot of retail investors in the period between 94 and 2004. And my request to all of you who are all customers is that, and I've seen between 94 and 2004, I'd seen 94, 95 bull market. I'd seen 97, 98 Asian financial crisis. 99, 2000, 2001, Ketan Parekh and the internet bubble. So I'd seen all these things dealing with retail brokers, retail customers. So my request to all of you is that it is very important to be disciplined as an investor. And I have noticed that all the people who have been disciplined as investors, they made a lot of money. People who have not been disciplined have not made money over the long run. And that is my earnest request to all of you. And to be disciplined involves that at some point of time, you should avoid greed. And at other points of time, you should not get fearful. Like this year was a year that in March, April, if you are not fearful, and you gathered the guts to buy in March, April, when the whole market was fearful, you would be sitting on such huge profits at this point of time. So my honest request is, please be fearful when everyone else is greedy. And please be greedy when everyone else is fearful. That's what Warren Buffett says, and that is my earnest request to all of you. And that is, I think, the lesson I learned from watching all the retail customers in my 10 years of looking at stockbroking. And the second thing, if you ask me, the only other thing that I want to talk about before I have an interesting session with Venkat, whom I know for years, is that please practice asset allocation. And my learning has been that if you practice asset allocation, you have won it. And that was our base framework, which I learned over a period of time, because there is no asset class which completely goes out of favor. So people come and tell you that real estate is completely out of favor, be more positive on real estate. If someone comes and tells you that gold is completely out of favor, be more positive on gold. If someone comes and tells you equity is totally out of favor, be more positive on equity. Someone comes and tells you debt is totally out of favor, be more positive. Similarly, if everyone around you has made too much money in real estate, like was the situation in 2013, you have to be very, very careful in real estate. If too much money has been made in gold, you have to be very careful. Too much money has been made in equity, also you have to be a bit careful. So I would say that asset allocation is such an easy way to make money. And this was our learning as a mutual fund. And that is why we decided that we should focus on asset allocation, because asset allocation is such a low risk way to make money in the long run for all investors. That is the second lesson that I learned. So I would say one is be disciplined. Second is practice asset allocation. And if you do both these and you're willing to save, you're going to make huge money over the next 10 years, 20 years, and 30 years through IIFL and through ICICI Mutual Fund. This is my learning, and I now hand it over back to Venkat for our Q&A.
Thank you, Naren, for your opening remarks. Already I have a question from one of the audience, but I'll keep the question for the end because that is linked to asset allocation, which you spoke about. So I'll keep that for the very end, where you can share your views on asset allocation and your advice to investors who are in the audience. My first question to you is on the rally. The rally has caught everybody by surprise. In the month of March, as you said, everybody was fearful. In the month of December rather, everybody is absolutely like, I don't know what is the exact opposite of fearful, but absolutely courageous. There's no risk on the table. Everybody is buying as if there's no tomorrow. So you had, what do you make of this sense? Because the underlying economy is not gone, I would say, anywhere. It's improving, but nothing to write home about or reflect this 13,500 Nifty and so much euphoria.
So I call it the developed world central bank bull market. That's the word I've given to this bull market. It was done by the Fed. The developed world central banks have put in $28,000 billion of money in the market. They have put in already 24,000. I'm told they are going to put $4,000 billion next year. I can't type the number of zeros in it, and I can't even convert it into rupees. That there are so many zeros, and that is the reason why the stock market is where it is. And so much of money being printed by the developed world central banks is what has resulted in the economic improvement and the equity market of 13,500 Nifty in India, and 30,000 Dow, and NASDAQ of 12,500. So what you have to remember is, at some point of time in the future, that doesn't mean in the next 1 month, it can be in the next 3 years, it can be in the next 2 years, inflation will come, and the developed world central banks will say, I have to pull out money from the market. At that point of time, the market will fall. Does it happen in 2021, 22, 23, 24, 25? Naren doesn't know. And no one in India will know. That is a tragedy. But till that point of time, till the time the developed world central banks keep putting in so much of money into the markets can keep going up. And the reason why the markets went up is because of this $24,000 billion. And as I said, it's difficult to count the number of zeros itself. That is the reality. It's like almost so much money has been printed. And this year they printed a record amount of money in March when the market fell. And none of us realized that the amount of money printed was a record. And that's why the market recovery was also so phenomenal. And it was printed in US primarily, and it helped the entire world. And that is the reality of where we are today. And we should be aware that we are all beneficiaries of this developed world central bank bull market. And it has made all of us richer in rupees. We should know that.
And makes all of us feel happy also, strangely, because when the Nifty is 13,500, there are people smiling. But
yes.
Again, I know that you will answer this in the framework of a macroeconomic, because what is the state of the recovery of the economy? Because at least if you see April, May, June were write off, but now again GST numbers are coming back to 1 lakh crore mark. People have started talking about sales pickup. And is it that some pockets of the economy doing well, some are absolutely in bad times, and the organized part of the entire economy is doing well at the cost of the disorganized sector? How do you construct the entire macroeconomic picture from your desk as the CIO?
To my knowledge, economy is picking up. I don't know where all things have not improved. Certainly, travel has not picked up. Tourism has not picked up. Lot of people in the small enterprises have not doing well. See, just imagine what we are talking is, suppose you are sitting in Nalasopara today, or you are staying beyond Kalyan and you needed to operate in Bombay. With electric trains not working, it's been very difficult to actually operate, because how do you run your business if electric trains are not working? So anyone who has a business in Bombay and who's staying beyond Kalyan or staying beyond, let's say, Borivali, how does that person manage to run his business? All those businesses are in deep trouble. But otherwise, economy has been improved because interest rates have come down very, very low. People don't want to invest at such low interest rates. So people have even started to look at real estate. If you look at it, the government of Maharashtra brought down stamp duty to low rates. That has resulted in record amount of stamp registration of properties. So even real estate market has seen an improvement. And you're seeing a lot of transactions in real estate. You're seeing that car sales have improved. Lot of economic trends are seeing improvement clearly. But at the bottom of the pyramid, there are a lot of challenges at this point of time. Entire rural economy has been decent because this year's monsoon has been good and Kharif crop has been good. So overall, I would say that the rural part of the economy has been in good shape. If you look at tractor sale, it has been in record actually. So I would say there are parts of the economy which has been doing well. There are parts of the economy which has been doing badly. But everywhere things have been helped by lower interest rates. And everyone is saying, I don't feel like putting money in a bank at 3% or putting a bank FD at a 5%. Let me go do something with it. So I would say lower interest rates has definitely spurred the economy. Lot of investors in the market are also saying, I don't want to put money in an FD. So they have started to trade stocks. So I'm sure your business must be booming because people are saying, I am going to trade stocks. I'm not going to put money in a bank FD. So that has also picked up substantially from April, as you know. So there has been a big benefit out of lower interest rates, which has really changed a lot of things in the economy. Will it continue? It may, because this has started a trend. See, real estate was stuck for years. Now, if transactions happen and real estate gets liquid, that sets a very positive trend for many things to happen. So if real estate deleverages and lot of builders problem solve, that actually helps a lot of things. So things could be improving and we could be at the start of a better economy, particularly if interest rates continue to remain low and oil also remains low. And I think that, for example, government came up with one SME guarantee scheme. That scheme was very well conceived because that ensured that a lot of SMEs didn't go bankrupt. that scheme had not come, lot of SMEs would have gone bankrupt. And that ensured that a lot of SMEs didn't go bankrupt. So I think overall things are improving. Is everything improving? Answer is no. But are a lot of areas improving? Yes. In fact, areas like real estate are better than pre-COVID now. And stock markets are better pre-COVID. Stock broking is better pre-COVID. So all these things are, that is the situation. And that's why I don't think, but at the same time, is everything normal? No. And always everything will never be normal. Something will be down always.
So to answer, to ask you a question, which is that if you look at it, we had the entire, I would say, the rally or and the recovery linked to the rally is somewhat linked to interest rates. As you said, developed world central bank is printing currency, keeping rates low. So we have also seen a rally in commodities. So if you see rates are low, commodities now oil, which in the month of, I think April had a negative price. Now it's again becoming healthy at about $40–45 a barrel. So what is your view on commodities? Because if commodity cycle again picks up, then our friend inflation will also come back sooner or later.
I think there is a problem in the longer run, but right now inflation is good. Inflation is equal to profits. People didn't realize that. See, inflation is one person's output and another person's input.
Correct.
So if steel prices go up, steel company makes more money. If aluminium prices go up, aluminium company makes more money. If potato prices go up, potato farmer makes more money. So one thing we have never understood, and everyone likes the inflation to be low, but inflation is too low, profits are very low. So inflation increasing is sometimes one person's output, and that person's output means higher profits. So I think in the near term, we are going to have higher inflation. Higher inflation is going to lead to higher profits, and that will be good in the near term. This does not mean that the next 3 years everything is rosy, but in the near term everything looks positive. Except that I think I don't think it's really good for putting money in some. I mean, interest rates are so low that is it wise to put in commodities? Is it wise to put in equities? Yes, with the risk. But are you going to see interest rates are going to go down from here? I don't think so. I think that phase is over. I think inflation may come back. I don't think interest rates will go down from here. I'm not a believer in that. But I think inflation sometimes is very good for corporate profitability. If you look at the period from 2002 to 7, inflation went up, corporate profits went up, economy went up. So we all seem to think inflation is bad, but inflation is required sometimes for economy to pick up. And that may be the phase we are in at this point of time.
That's a very interesting analogy you gave for the period of 2003 to 2008. And that was one bull market when the Nifty Sensex touched 20,000 plus for the first time. And there's a feeling of, I can't explain to you, but I've been a retail broker. So there was a feeling of joy because somehow we felt happy. But this time around, when the Nifty has done well, we have a 13,500 Nifty, 46,000 on the Sensex. That feeling of joy is not pervasive. So is it linked to that fact, what you said, that time the economy was doing very well, all sectors was participating, so there's joy. Now you have a bipolar kind of market. Somebody is doing well, somebody is not doing well, so there's a feeling of left out.
I think many of your investors must be joyful. I don't know why you are not joyful.
People are missed out. There's a question to you. What is your advice to investors who are sitting on the fence and still not invested because they think they've missed the rally? So now I can ask you this question, which has come from one of the investors.
That is the tough part. But I think a lot of people are joyful. All the people who started doing investing in April, May, they must be joyful. Why are you not joyful about them? All the people who started investing in April, May. In fact, the data suggests that after April, continuously, people have been investing in equities in India. The data suggests that. So I believe that a lot of joyful investors are there in India. So I think, unfortunately, we are all become bears over a period of time. We always think negatively. And unfortunately, age is not on our side, maybe. So we are all used to thinking negatively. But the question you asked is the toughest question. And every day I'm asked this question, what do I do today if I'm sitting on too much cash? It is a very tough question. So I tell people, invest something in equity, invest something in gold, and then pray that the market rally continues. This is what I tell people. But the reality is you have missed the safest part of equity returns. This is very, very worrying to me. I tell people invest in value stocks, invest in value funds. They have done pretty badly for a long period of times. That is the better thing to do at this point of time, because at least there you are not, they have not done well for a long period of time. Maybe that is a way out at this point of time. But it is a very difficult question you have asked. There are no easy answers. But this is what I'll tell you. Invest in value funds, invest in value stocks, because they are at least not gone up for 10 years. There are sectors like power, telecom, pharma to some extent, metals to some extent, construction to some extent. All these sectors, they have not done well for PSUs to a large extent. They have all not done well for 10, 12 years. So even today, if you invest in some of these categories, actually you're not investing after a big rally. So that is how I look at it at this point of time. You can choose to invest in them. Because even in globally, if you invest in FANG, you're investing after a 12-year rally. But other stocks have not done well for 12 years. So this is what I'm thinking. But it's a tough question to answer. And maybe my answer, I hope I'm right.
See, actually, we have been also talking to our investors, and you yourself have run a very well managed value fund. So I just want to ask you a question: are we in a beginning? Because till recently it was growth at any price. Now you think there's again value, as you rightly pointed out, has not done well for say a long time. There's a lot of literature in the world investment community, which everybody is now talking value should come back. And there's a very famous fund manager also, no, Shutters Value Fund. So maybe this is a time that value will come back. So what is your thoughts on that?
This has been our view, that value will come back. And for the last 6 months, we have been saying that. First 3 months, we got hammered. We said value will come back. First 3 months, value actually did even worse. But last 2 months, value has been doing very well. And we think it has a lot of scope. But when will it stop? I think finally inflation will come back. I think oil will go above 60. Inflation will come back. At that point of time, US increases interest rates. At that point of time, I think value may do better, but I think everything will not do well. But that is all not tomorrow. It could be 2 years from now. It could be 3 years from now. It could be 5 years from now. It could be 1 year from now. But I'm saying I feel that till inflation comes back, I think value will do well. That is my broad view. And you've seen that even yesterday, for example, because I'm not talking Indian stocks, there are a lot of, yesterday NASDAQ fell sharply. So somewhere I feel that trend has already moved from growth to value. And I feel value will have a rally. But after the value rally, everything will become expensive. And then you can have a correction across the world in stocks. But I'm not making a case it will happen tomorrow. The correction will happen tomorrow. But you have to remember, you're in a boom market. In a boom market, you have to remember that investing in equity in a boom market requires care. You cannot invest mindlessly. If you are investing in a very, very cheap market, you can invest and forget. We are not in that kind of a market. In this kind of a market, you can invest today. Value is very cheap. But at some point of time, you have to remember that everything will become risky. And that is why, as I mentioned in my opening talk, an asset allocation approach ensures that you have some money in equity, some money in debt, some money in gold, some money in real estate. That kind of an approach is better than saying, I'll put all my money in equity. Because when the market corrects, equity will not be a riskless asset class. That is how I look at it.
We spoke about the entire inflation coming back, economy doing well, and there's one sector, the capex sector, which you talked about, infra, power. Do you think the capex cycle which will come back? Because the last time we saw a massive capex cycle taking place was 2003 to 2008, and for the last 12 years, everybody is still recovering from the excesses of that period. So, what is your view on capex? So, like the entire infrastructure construction pack, which because in India it requires capex to kickstart the economy.
I think some part of capex will come at the last part of this cycle. Because even today, if you take power demand itself has to go up. Only after power demand comes up does power capex pick up. Lot of sectors have low capacity utilization even today. First, capacity utilization has to go up before capex. So, infrastructure like metros, those kind of things already capex is happening. So, but I still believe that area, infra-related areas, definitely there is scope because 10, 12 years, no return. Most of the stocks are trading at 2007 prices, much lower than 2007. So that way, there is much more margin of safety there. People have just given up on those areas. So therefore, there's more margin of safety there.
And you briefly spoke about PSU banks or PSU stocks, not PSU banks. I take sorry. So again, this is one pack which has continuously, I would say, flattered to deceive. So I'm sure there are a lot other issues related to governance and stuff like that. So let's not talk about that. But what is your view on the PSU pack? Is suppose tomorrow or day after there's a disinvestment happening in BPCL, then there's will be a massive re-rating of entire pack, and most of them are actually trading at cheap multiples.
So my view is simple. Anything which has done very badly for 10, 12 years, you should consider. So these are all sectors. Infrastructure is one area. Metal is another area. Telecom is another area. Power is another area. PSU is another area. So my thesis is that in 2012, we launched a US blue chip fund. When we launched the US blue chip fund, there was 12 years of no return in US. People were not interested at that point of time. It gave blistering returns from 2012 to 20. Now everyone is saying, I want to invest in US. I get very worried because 8 years, the returns have been fabulous. Now I tell people, be very, very careful in US. 8 years of blistering returns in US. Now everyone wants to invest in US. You have to be careful. Whereas you look at these sectors, PSU, infra, metal, telecom, power, construction, no returns for 12 years. Now you should invest in these areas. Whereas if you invest in US, you are investing after 8 years of blistering returns. Be very careful there. So this is what I believe in a cycle. So wherever 8-year returns are zero, residential real estate and all these areas, I'm more positive. Whereas 8 years back, I used to be very negative on residential real estate because residential real estate had gone through a 10-year period of very high returns. And I used to be very worried. Now I feel that these are all sectors which are much better.
So if you look at the entire Indian construct, there's one audience question about interest rates. So you have answered this question, but just people wanted to ask you that when you talked about the interest rates having bottomed out, but still the upcycle has not started. So the question is that when will we see the upcycle? So in the next 6 months, 9 months, or it will remain for some time till the economy gets back its health?
My view is after oil goes to $60, the upcycle will start. So when will oil go to $60? I don't know. But whenever oil goes to $60, upcycle in interest rates will start. So oil is one commodity which has been very range bound. Even today, if you look at it this year, all the metals have gone up. All the metal prices have gone up. Steel has gone up. Aluminum has gone up. Copper has gone up. Zinc has gone up. But oil has not gone up. But if oil goes to $60, you have to predict interest rate increase. So I still believe that if I take a 3-year view, interest rates will be higher than where we are today. Today, all the top corporates in India are borrowing 3-month money at 3%. Can you believe it? Top corporates are borrowing at 3% for 3 months. They are borrowing at 4.5 to 5% for 3 years.
Years.
I have never seen this kind of interest rate in my entire working career of 31 years. So I believe in the next 3 years, interest rates will go up. When in the next 3 years it will go up, I also don't know. And that is why today I think it is much better to invest in a dividend yield fund rather than to take a big bet in some gilt fund or something like that, because I feel that gilt interest rates will go up in the next 3 years. How long can it be low? Whether it will go up in 2021 or 22 or 23, that I also don't know. And that's one of the things about investing, which many people don't realize, that we may be people who have seen markets for 31 years. But we also don't know so many things. We never knew market will come down in March by 25%. If we had known that market will come down in March by 25%, we would have told everyone, be very cautious. But we didn't know that. In March, we didn't know market will go to 13,500 by December. If we had known that, we would have told all of you. Unfortunately, markets are not in our control. Markets move in the way it wants to move. It's not in our control. Unfortunately, everyone thinks that we all know everything about markets, but unfortunately, markets is made up of how people react to the events.
So coming to one more question about investors, you talked about asset allocation. So people have to put money in debt. So, and interest rates are low. So how should the entire our investors look at investing in debt?
Tough question. We actually tell people to choose categories like balanced advantage fund as a way of investing in debt rather than pure debt. Because debt standalone is a very, very difficult asset class, because we don't know how people will get returns out of debt. And we don't even know what return they'll get in debt if they invest. So we tell people, invest in a fund which has a mixture of equity and debt, rather than in investing in debt standalone, because we know that if you invest in debt today, what return will you get? You'll get yield to maturity minus expense in a mutual fund. If you invested in FD, you know what FD return you'll get today. So that is the challenge at this point of time. And it's a tough task today where to invest in debt. I'm scared to tell anyone where to invest in debt. I don't know what to do, but when people ask me, I tell them, you invest in a product which has both equity and debt, like balanced advantage category, because that becomes a much better way, because there you're getting a mixture of equity and debt. You're not getting debt alone. And therefore, what happens if market goes up, we sell equity, buy debt. If market goes down, we buy equity. That kind of an approach is better as a way of investing in debt than standalone debt.
So effectively, you're saying is that this balanced advantage fund kind of construct gives you a higher return with lower volatility, because you balance the otherwise at pure equity, at pure debt at 3% is very, very challenging.
Very challenging.
Hello?
That's the right thing. I hope I'm audible. Audible?
Yes. So you already answered the question about the US markets, so I will not ask you about that. But one interesting question somebody asked is, you also answered about your views on real estate, but what's your view on gold?
So I tell people, if you are at 1%, take it to 2%. If you're at 2%, take it to 3%. If you're at 3%, don't take it to 4%. That kind of a view I've been telling people when I do meetings. I'm so confused on gold today. And I must tell you, both of us come from IITs of late 80s. Many of us have friends in US. All of them are buying Bitcoin these days.
Actually, sorry, you're jumping the gun, because there's another question on cryptocurrency. So please give your views on crypto as well as gold.
All my IIT friends, they're all buying Bitcoin. I ask them why. They say gold and all is obsolete. They're saying we'll buy only Bitcoin. So I don't know. I told them, why are you not buying gold? They say, gold and all is obsolete. We'll buy Bitcoin. I told them Bitcoin is illegal in India. What is Bitcoin? It's not even government guaranteed. They say, no, Bitcoin is very important. I don't understand this Bitcoin. No, gold and Bitcoin seem to be competing with each other. And that is why I tell people, boss, India, all the people, I tell people, boss, if you are at very low weightage to gold, you increase some weightage, because gold hasn't done well recently. and equity has done very well, so increase your weightage. But if you already have 2-3% of your net worth in gold, don't increase weightage, leave it, because we don't know whether Bitcoin is the next gold. If Bitcoin turns out to be the next gold, gold will not perform. This is the problem. So that's the confusion which I have in my mind after talking to all my IIT classmates in US. In India, it's illegal. So none of us can talk about it or do anything. But all the US guys are buying and selling Bitcoin these days. And there are some 10 Bitcoins, different currencies, some Ethereum, Bitcoin, something.
I have an interesting anecdote to share. You talked about the Balance Advantage Fund. I don't know if you remember, in January of 2018. So I had the pleasure of meeting you, and that time the small cap, mid cap stocks had rallied dramatically, and you had told me to reduce allocation and told me to buy Balance Advantage Fund, which actually I've done. I'm an investor in your Balance Advantage Fund, and touchwood, it has done well. So now we have seen 2 years of underperformance of small cap and mid cap, recent rally notwithstanding. So what is your feeling now? Do you think it's now time to say lagao small cap, mid cap mein, or you're still skeptical?
No, it's fine. I don't think, I think I'm more worried about people just buying US equities left, right and center. I think, see, I look at where is consensus very hot. Consensus is too positive on US equities. Consensus is too positive on quality stocks in India. Those are the two areas where consensus is very positive. So wherever there is consensus and valuations are high, you have to be careful. Small and mid caps, there's no consensus today. You look at it, where is the consensus? There is confusion. If there is confusion, you are much safer. Wherever there is consensus and money is going in that area, that is where you have to be worried about. So today we are worried about quality stocks, quality mega caps we have been worried about, because there everyone is saying this company, this quality mega cap can never go down. And people say this US stocks will never go down. These are the areas which are most overvalued today at this point of time, is my view. Small and mid caps is okay, but as you know, equities itself is not an undervalued asset class today. So while you can invest, and it looks like in an inflationary environment, equities has always done well. So you have to remember that it will do well till the day the US central bank says, I am going to fight inflation. So you have to remember that you have to take a bet, which is the day inflation comes in USA. And the bull market lasts till the day USA says, I am going to fight inflation. Right now, USA is saying that I have no worry about inflation. I'll keep printing money. Till the day they keep saying, I'm going to print money and not worry about inflation, equity market has no problem. The day they say we are going to worry about inflation, that day the markets will tank. This is the situation at this point of time. How to convey it to people. At least here we are dealing with equity investors who are at least aware of some things. I have to deal with mutual fund investors. How to explain this to people? We are struggling. Because how to tell people this equity market will rally till the day inflation comes in USA? I don't know how to convey it to people. And I don't have a date. I can't tell you that it will come in 1 year, it will come in 2 years. I can't tell you a date. Because the US central bank says, till inflation comes, I will do nothing. I keep printing money. That's what he has said.
Interesting. So there is somebody who's in the audience who's asking a question that you are saying that high P stocks, quality stocks are expensive, but money seems to be going there only. And look at Asian Paints. It was expensive at 1,000, is expensive 1,500, is expensive 2,000. Now it says, okay, I'm at 2,500. Do what you like. So what is driving this kind of?
Because more and more money goes there. That's the situation in quality stock. Just because something becomes overvalued doesn't mean that it can't go up further. So, but doesn't mean it is cheaper. In 2010, Bombay real estate was expensive. It kept going up till 2013. Then from 2013 to 20, Bombay real estate gave no returns. So just because it became expensive in 2010 doesn't mean it didn't go up for 3 more years.
No, so, so is this the rise of the quality names because of passive flows? Because human beings will be afraid to press the trigger on.
It is because of passive flows and active flows, both.
So
And
what is?
Lot of people buy those stocks also. They say, let's buy the stocks which have done well. Both.
So what's your view on passive investing? Is the era of passive investing coming back? Oh, sorry, not coming. Will pick up in India the way it has done in other parts of the world?
It may. But right now what happens is in India, what happens, there is a direct equity culture. So I was part of the direct equity culture between 94 and 2004. So direct equity culture exists. Passive is some kind of a replacement of direct equity culture. So whether direct equity culture happens or passive happens, I'm a bit confused. Because when I see companies like yourselves and many others, they are all part of direct equity culture. So does direct equity happen or passive happens? Or direct equity happens along with passive? That's a question I'm not able to answer at this point of time. And maybe you're better equipped to answer that question. Does passive happen or direct equity happen? I will ask you that question.
See, actually, to be in our views at this moment, at least 3 months, 4 months period, we have seen is the interest in direct investment has increased a lot. But that is because we have seen a massive rally. So, but if you had asked me the same question maybe last year, so I was of the opinion that more people are asking about ETFs and stuff like that. Now, everybody wants to buy stocks. Let's be honest.
I feel that direct equity is a competitor of passive. Passive is a competitor of active. So I think all three will coexist in India. Direct equity, passive and active. All three will coexist and each of us will compete with each other. Passive is going to compete with active. Direct equity is going to compete with passive. And many of your customers will ask yourself, should I do direct equity? Should I do passive? That in your case, that will be, some of the people will ask, should I do passive equity or should I do passive or should I do active? So what we did was we said, let us do hybrid because it is like a mixture of both equity and debt. That also we said we will do because that is something which is more difficult to do on a passive basis.
So
because debt is very difficult to do on a passive basis.
Which is that hybrid fund of yours?
Balanced advantage.
Balanced advantage. Okay, yeah.
Because to do debt on a passive basis is very difficult, as you know.
And coming to your a question which you had answered, but I would like to ask your personal views on this. What is your advice to a customer who wants to ask you a question that, yes, I agree with you on asset allocation. Please guide me on your asset allocation. So assuming he's a conservative, normal human being and he has 100 rupees to invest. So how does, you said 3% to gold. And what about the other things?
It's tough. Right now, I'm more positive on equity than I am on debt. But finally, at the end of the day, each person's risk profile is different. It's much easier for me to say that I'm more positive on equity than I am on debt today. 17, 18, 19, I was more positive on debt than I was on equity. After interest rates have come down to this level, I've been much more positive on equity than I have been on debt. And within equity, I'm more positive on value than I am on quality and growth. Within small, mid, large, I'm not clear which of the three I'm more positive on. I'm much more positive on value than I am on what I would say than small, mid, large. Small, mid, large, everything looks okay to me at this point of time. I'm not negative on small and mid, certainly. And I believe that the reality is that I believe that at some point of time, when US inflation comes, whatever be your asset allocation, if you have the ability to, at some point of time in the next 1.5 years, what I would do is, when oil goes to 60, I would start trimming equity. If oil goes to 60, I would start trimming equity. 60 I would sell some, 65 I would sell some, 70 I would sell some, 75 I would sell some. And maybe after, once oil comes to 75, maybe I would have a very, very big underweight in equity at that point of time. That is how I'm thinking at this point of time. That once oil goes to around $75 per barrel, one should be massively underweight equity at that point of time. This is how I'm thinking at that point of time. And at that point of time, I may have to keep money in cash, earning nothing for a short period of time till the time markets correct. This is how I'm thinking at this point. Maybe I can keep that money in gold also if gold is cheap at that point of time.
There's one question for you specifically related to balance advantage fund. One of our audience is asking a question whether balance advantage fund kind of strategy will play out for say 10 years, 15 years, or it should be a part of the portfolio and you should look at other funds like equity funds to give you higher returns.
See, one of the things I learned from my 31 years is that no one teaches you when to sell. The entire financial ecosystem in any part of the world, whether it is America, India, US, Europe, Singapore, Hong Kong, everyone teaches you how to buy. They never teach you how to sell. They only teach you how to buy. Balanced advantage as a category, we sell for the investor. We sell equity when the market goes up. So it's actually a buy it, shut it, forget it kind of strategy. Because we are selling for the investor, we are buying for the investor. So if you take this year, we have bought in March, April equity. Now we are selling equity. So it is a permanent fund actually. It is not a tactical strategy at all. And that's how we look at it from an investor point of view. It's not a tactical strategy at all. But it is not a replacement if you are the kind of person who enjoys direct equity. You can't, the thrill of direct equity, you won't get in that fund. This is your investment. Direct equity, you can make 20% in 2 days. You'll never be able to make 20% in 2 days in that fund. So what I'm saying is part of your investment you can have in such a strategy, but along with that, you have to do direct equity. Direct equity will give you the thrill.
No, suppose you're constructing an equity allocation for a customer. I'm assuming a normal customer, 3% gold done, 37% debt funds done. So now I have 60% to invest. So
you can comfortably put 20-30% in such a strategy.
Okay. Or as you said,
and it's not tactical, it is structural and can be kept across cycles.
Okay. Or as you said, use the BAF to replace the 37% in debt because you get more volatility, and in 60% put large cap, mid cap, whatever funds you want, so that you have peace in everywhere.
Yes.
So I hope I've answered that question. And what is your view on the IT sector? Now IT is supposed to be back in.
IT is a good sector. And I think it's a good sector, but the sector is neither cheap nor costly, somewhere in between. So I believe it's a moderate return, low risk sector. But I don't think the sector can give dramatic returns from here at the current share price. I don't think so.
Okay. And
but I think if the market were to fall 20%, I don't think it will fall 20%.
Okay. And pharma?
Pharma, after the rally today, it is also similar to IT.
And FMCG is what you said is that high quality, overowned, expensive.
I have gone wrong. I thought it will correct. It never corrects. Even last 1 week, if you see every day, it goes up now.
Yes. I think suddenly Hindustan Lever has woken up and it started flexing its muscles. And so we asked. And one last question before we end. What is your view on calendar 2021 and how would you advise investors to plan? One crystal ball last question.
I think keep your leg on the accelerator and keep one leg on the brake. Be always watchful if you are trading equity. Don't get overexcited and keep increasing leverage or something like that as the year progresses, as the market keeps going up. I think 2021, all the strategists are saying markets will go up. Normally, when every strategist says markets will go up, you have to worry more. And every strategist says that won't give you returns. So that is the reality. So I think 2021 is the year of inflation, in my opinion. 2021 is the year where you have to be very careful at some point of time when inflation comes. So as I said, wait for the period when oil touches 60. Once oil touches 60, become very cautious. This is my way of looking at it from all of you.
And we spoke about your value funds. Can you just share 2-3 minutes your views on the value fund? I think it's called the Value ICICI Discovery Fund.
Yeah. See, we have two types. One, what we call special situation fund. It is called as an India Opportunities, where we identify special situation fund. It has a very, very special, it looks for all special situations. For example, if you look at the fund, it does not have most of the key stocks that you would think any portfolio would have. We have a value fund where we look for value stocks. So for example, it has many of the leading technology companies, leading pharmaceutical companies, and it has many of the undervalued good quality companies. So these are two strategies. The special situation fund is the higher risk, higher return fund. The value discovery is a value fund. So it has much safer companies with a lower risk, that kind of a strategy. That fund is, the special situation fund is called India Opportunities. The value discovery is called, it is value discovery. That has been in existence for a long period.
For a very long time, for last 10 years or so. Thank you so much, Naren, for sharing your time and your views on the stock markets. And from all of us, wishing you and your team a very happy and prosperous 2021.
Same to all the investors. I repeat, be disciplined as an investor. I have seen 10 years as a stockbroker. I have seen a lot of people make a lot of money and then lose it because they are not disciplined. So remember two words, one greed, one fear. Always keep thinking of this word called greed and fear. The third word that I always tell people, respect asset allocation, respect asset allocation, respect asset allocation. Don't put all your eggs in one basket, whether it is real estate, whether it is equity, whether it is debt, whether it is gold. You will come out winner. This is my learnings out of my 31 years after IIM. And like Venkat, both of us have spent 30 years in financial services markets. And we have all seen all these cycles. So I can tell you that if we do this, we are guaranteed making money over the long run. There'll be times when people will say, you're an idiot, you're not taking risk, but it's okay. Finally, at the end of the day, we have to make money over a lifetime, not money in a year. And we have all seen this year Sony Live. So you can see that once for 6 hours one day, paying 299 rupees. You will know how some people called him star and later called him dog. So that is what I would like to share. Thank you all.
Thank you so much, Naren. Wonderful talking to you. Thank you. Have a nice day. Thank you.
Thank you.